What are your odds at this point of a recession as we note that data that's crossed the screen in terms of the terminal, the US July Dallas Fed manufacturing index falling by 22 to 22.6 versus an estimate of 17.7, just underlying the softness of the economic data that we're getting out of the US. What are your odds of a recession at this point?
Yeah, well, first, thanks for having me. So we think over the next 12 months, recession is more likely than not. And there's really three things that I would really point to supporting that view. The first, as you've mentioned, the economic data have clearly deteriorated lately. It's not just the data in the United States. Also, we've also seen purchasing managers' indices within Europe and elsewhere deteriorate to a point that is more consistent with a contraction in real growth. But secondly, we've also seen inflationary supply shocks that are worse than expected. Obviously, the geopolitical turmoil and the war in Ukraine have resulted in a bigger reduction in energy flows to Europe than we had previously expected. That sort of supply shock is going to have stagflationary pressures for the global economy, including the U.S. And then just finally, within the U.S., inflation is looking more persistent. Wages and housing and shelter inflation. So that just means the Federal Reserve is probably going to have to go higher and maintain more restrictive policy for longer to bring that back down.
So, Tiffany, would you be protecting against inflation now or a recession now? Which one should investors be focusing on first?
Well, I think that, one of the things that's kind of interesting about this recession that's going to be quite different from more recent recessions that we've gotten over the last, call it 20 years, is that this recession is going to be characterized by high inflation. So there are implications to that. And one is just the counter-cyclical response that we get from both monetary and fiscal authorities is going to be quite different to a recession this time. They're not going to be able to accommodate a recession like they have in the past. So what does that mean? Well, it could mean that we might have a shallow recession, but it could be more prolonged, meaning that we get several quarters of kind of a slow contraction, but then ultimately gives way to sort of subpar, below trend growth for quite some time until we are getting inflation that's more consistent with the Fed's mandate.
Where would that scenario then, Tiffany, leave the US jobs market?
Well, ultimately, the jobs market is going to deteriorate. We would expect you to get increases in the unemployment rate, as well as negative month-over-month job gains. And we've already seen, various indicators that tend to lead the job market, really start to deteriorate and suggest the unemployment rate is going to move up. I think the Federal Reserve is also preparing for this. You saw in their latest summary of economic projections that they were even expecting the unemployment rate to move up. We think that it moves up a little bit more than they do as a result of a view of recession. But certainly the labor market is not going to be immune to this. And one other thing with that is keep in mind that if you are trying to cool off the economy, one of the channels with which you do that is to slow aggregate income growth, slow the labor market, actually, unfortunately, have people lose jobs. That's the blunt tool that the Federal Reserve has to get inflation back down.
So, Tiffany, what is so perplexing me is how much investors are trying to front run all of this. And the way it occurs to me is that the Fed's going to want higher rates to cool down the economy and tamp inflation. Yes. If they talk up those rates, then the fears of a recession happen, and then the rate cuts start getting factored in, which then dents the rise in rates, which then affects what the Fed can do. I just don't understand how this is going to wind up working.
Yeah, I think it's a very good point. And just to answer that, I would point to the fact that the Fed and monetary policy works through a broader range of financial conditions than just interest rates. And that includes, equity prices as well as the dollar and credit spreads. And so, you have to think about that broader range when you think about how tight monetary policy is. And in this kind of environment, although you might have recession risks that are weighing on Treasury yields and keeping them down. In that kind of environment, you probably have higher equity risk premiums. You could have the dollar, that's also benefiting, appreciating from flight to quality flows, and those things will tighten financial conditions as well. So overall, we would argue you probably are going to get continued tightening in financial conditions more broadly, although that might mean that rates, at least longer-term interest rates, continue to rise.
So just to unpack that a little bit, Tiffany, in terms of the yield spread, and how yields move, as we look into the early part of 2023, on the back of this rate hike trajectory, do you see yields being capped at the levels they are? How much more further? We're seeing a lot of action towards the back end at this point. The front end is a little lower now. And that, of course, inversion that we're seeing between the 2s and the 10s. Is there a point where things start to adjust?
Well, ultimately, I think what the market is telling you is that the market expects the Fed to be in restrictive territory. And that's why you're seeing that inversion where the short-dated interest rates are somewhat higher than longer-dated interest rates, depending on what points on the interest rate curve you look at. And we would agree with that. And I think the Fed has also suggested that they need to bring monetary policy into restrictive territory. Now the actual level of any given interest rate will be impacted by many different things. We kind of lump those together, call it term premia. But so I think that the thing that we should be watching right now is more the interest rate curve. It has been a good predictor of recession in the past. Of course, when it's inverted, it has suggested or foretold a recession that is going to come.
Tiffany, what would be restrictive in terms of interest rates? Like, are they going to go to 4, higher? How long do they stay there?
Yeah, I mean, I think that is a key question that's being asked, because not only do we not really know how high we need to be, how restrictive we need to be, but there's also some question about what exactly the level of interest rates would be consistent with neutral policy. So either neither expansionary nor contractionary. I think the one thing, though, that is clear right now is that 1.6 on the federal funds rate is not only not neutral and not restrictive. It's not only not restrictive, but it's not neutral. So the Federal Reserve, in our minds, at least needs to get policy to neutral, at this point. And I think that's why we've seen these outsized adjustments that they're going to deliver. And of course, commentators expect another 75 basis points at this meeting this week. We think it could be more, just to get policy back up to neutral. And so, it does look currently at a sink with economic fundamentals. There's there's a lot of questions around how the economy will start to react, because monetary policy works through lags. So we have to start to see how the economy reacts to the rate hikes that we've already gotten, in order to really gauge how high is restrictive that'll be necessary.